Hey everyone, welcome to the KE Report, another daily editorial. We're going to be focusing on the resource sector more from a trading desk perspective, as I am chatting with Darrell Fletcher, Managing Director of Commodities at Bannockburn Capital Markets. I've been bringing Darrell on a monthly basis to provide really an insight into what he's seeing on how bigger companies are hedging their exposure to different commodities and how he views some of these commodity moves in a much bigger picture sense. Darrell, let's start with natural gas because that has hands down been the most interesting out of the major commodities that we talk about. Natural gas recently shot up to about 350. That was a high for the year. It pretty quickly reversed, but still up around that 330 level, which is generally higher than it's been trading most of this year. Got to ask though, Darrell, is this mostly just a seasonal play here for natural gas, or is something bigger going on?
No, yeah, thanks, Corey. Thanks for having me on. No, this is pretty typical. We finally got a chunk of winter weather. Looks like La Nina, a lot of people are saying La Nina's fading a little bit on us. So well below norms, geez, most of North America, Canada, US, eastern half's going to get really cold over here in the US in the next 6 to 10 days. It's even spread into the 8 to 14 day. So number one, we're seeing some real weather finally. Number two, storage is neutral. It's kind of getting more neutral. We had to pull a 3 BCF here, which really seasonally is kind of normal. That I think would be the week ending 11/15. You start to get into neutral to a small build or small pull. We had a little pull. U.S. storage is 3.969 T, so we're below last year's average. I mean, last year's same level, about 141 BCF below, but we're still 239 BCF ahead of the 5 year. So that's turned more neutral when it had been bearish for a while. But then, the third thing on natural gas, and I think why we're seeing volatility really spike in the front, is the managed money's been short. I mean, prior months you and I have talked, I've been pretty bearish on everything, but the managed money's short, so we're seeing some covering going on there for sure. December Henry Hub rolls off the board tomorrow actually because of the Thanksgiving holiday. So we roll into to Tuesday. January comes on the board around 3:30. December's still stuck here at 3:30 today, but really volatile. We've seen, yeah, Jan looks like it's about 340. We've seen implied vols last week get up to plus 90% plus on this front. So it's kind of interesting again, finally. If we're seeing more weather-related natural gas, winter gas kind of doing what it does when this first happens. And we were just kind of in a low there for so long. I think there's a lot of positioning going on. Going forward, we're contangoed 25, it's kind of flattish, 335. And then 26, 27, 28 are all in that 370 range for Henry Hub. So yeah, it's been interesting finally. I would call it, you know, kind of slightly bullish finally. We'll just have to see. You're going to need this cold weather to stick, like it looks like it's going to, but that can change. And then you're going to need storage numbers, EIA storage numbers, to really show some strong pulls. And then you could be set up for some stronger Jan, Feb, March gas.
All right, I should note that we are recording this later in the day on Monday, so these rollovers, they're happening as this goes live on Tuesday. Dale, you mentioned some of the short levels from the managed money that were elevated in the natural gas sector. Where do we stand now? What's some of the data telling you about short positioning?
Oh, I'm sure I haven't seen the most recent. I'm sure there's been some covering going on last week. I mean, you had a 60, I think a 50, 60 cent move in one day or two sessions on top of the storage number coming out last Wednesday. So I'm sure some of it's been covered up for sure, but I don't have the macro view on that right now and the most up to date, but wouldn't be surprised because we're seeing it all along the curve, some covering up here in the front. Cal 25, and I mean it's still it's actually a little bit below the 1 year average still. We're like at 335. So it's most of this action by far is in the front. Cash prices last I saw 282.90. And yeah, to your point, are this is a year to date high for sure. I think you have to go back to October 23 to get to that 350 level, which we hit last week, but I don't think we closed over it. But 350 is definitely the test. And again, I think you'll need a combination of weather to stay hold for that, 8 to 14 day type to hold, and then you'll need to have pulls on storage. I think they're moving the storage number to Wednesday this week, all the DOE and EIAs for the next 2 or 3 weeks to get some firm ground here for it to move higher. But 350 will be the test on Henry Hub.
Okay. What about Trump's policies too? I do want to quickly ask you about the concept that he's going to reinstate all these pipelines, all these LNG terminals, and the expectation is that will push up the natural gas price in the US especially, and even in Canada, because some of this natural gas is going to get diverted overseas.
True. Yeah, I mean from an infrastructure perspective, that would make sense. I think it's really TBD for sure. I got to say, I don't take him literally, but I do take him directionally. I think a lot of the oil and gas companies, this is kind of including oil too, have kept to their discipline. And I think it would take time for a lot of these policies that he's talked about to really take place and see some bigger moves and increasing production. Now, for LNG, that helps we can export it out, but I think it's TBD for sure. And I do give the oil and gas companies credit for sharing profits with their shareholders, keeping the balance sheets stronger. So I don't know that it's going to be, there's incentives, but we'll see, if they really push it out or not.
All right, let's also move over to the energy sector. We also talk about being oil. Outside of a couple of spikes in October, man, oh man, the oil price has been fairly boring going the whole way back to September, capped around $72 down to about 65, 66. Again, there was that one spike in October up to 78, but that didn't last very long. So, what price levels are you watching for oil that you think matter in terms of maybe showing some direction, either upward or downward?
Yeah, I agree. I was looking, we've been in a $6 range since mid-October. It's kind of like watching copper. It's been pretty boring the past few weeks. You're off a little bit today. The Israel Hezbollah, they're talking about a ceasefire agreement that looks like it may be concrete here within the next few days. But in terms of price movement, this $70 mark is a kind of a weak anchor. It's been pushing up against it, below it. It's kind of like copper. It's kind of holding, but barely. So 70, you probably have to break down below. Well, 65 would be the next big test, but we'll have to see. It's been slow for sure. OPEC Plus has a meeting this weekend. Like I said, we broke down here today a little bit. We're down about 3%, and Brent is off to $73, but both of those are pretty similar ranges. Cal 25 crude WTI is about 67.50 and 26 is 65.50 range. So you're backwardated there still. But I think 65 would be the next test on crude, but 70's been pretty steady. We'll just have to see. To your point though, it's been kind of boring. So if we get a break, it'll break.
Now, from a commodities trading desk standpoint, you've been at a couple commodities trading desks. You set up the commodities trading desk at Bannockburn. What does a flat pricing environment, or at least a very tight range for months, what does it do to hedging, to trading, to open interest? What have you seen?
It definitely puts a lull in trading. It depends, like also if it's producer selling on the oil and gas side or consumer buying and products, say diesel and gasoline, which have been pretty attractive in the past month or two. But it does create some complacency, especially when if you're a buyer and diesel, Cal 25 diesel or 25 gasoline get to these lower levels, and but they stay, you can get a lull or some complacency in hedging activity just because they get too used to it, and natural gas is always a great example because that was so quiet and low for so long, and now you're getting 1 month moves. What are we up on the month here? About 32%. About Yeah, about 32. That's year to date now. It's hard. You got to be careful because of the front month activity, but you can get these big moves. About 30% on the month. So that's you just got to be disciplined about these hedging programs and stick to what your program is if you're trying to get risk neutral, or even more hedged in certain areas.
So, oil, which direction do you think it goes, or is the jury still out on that then? It's too hard to tell because it has been boring. And again, we don't know what some of the major players are going to do, including the US when Trump gets in.
Yeah, the fundamentals aren't positive, and you can tell we've taken some more geopolitical risk off the table. So if it really does look like if it's going to break lower. That's because you start to remove some of this geopolitical risk, supply and demand fundamentals. I think they're calling for 1Q 25, 2Q 25 surplus. So if it again, the $70 looks like a weak anchor, so we shall see.
Let's move over to copper then. We'll get into base metals more broadly, but boy, oh boy, copper has had just a wild ride this year. It entered the year right around that $4 a pound level, went flat for a couple months, and then skyrocketed up to 520 in May. Ever since that time, it has had a little downward bias, and especially over the last couple months, copper has been trending lower right down to that $4 level. Kind of a round trip all year, but boy, oh boy, not a smooth round trip. What's your outlook on copper? Make sense of this year's movements.
Yeah, it seems like it's settled in here now around around 410 a pound. You're right. Until just the past probably 2 or 3 weeks, it's been a wild ride. We're down about 6% now on the 1 month. So we've had clearly some U.S. dollar strength in the past month, and the base metals are off about 5% on the index. Dollars up about almost 2-3% on the 1 month. So you've seen that fall into place. But the forward curve too on copper is pretty flat. I'm gonna pull this here real quick. So it looks like it's settled in. Well, you start to get a little bit of contango as you get into early next year. But this four low, 14s seems to have settled in here after the big moves. So four over five, but it looks like it's pretty complacent here now at about the 410 range for December. We shall see. I mean, longer term is still constructive. Fundamentally, it's just, as we've said before, I think it's going to take time. The other base metals, we've seen nickel actually hit a 3-year low last year. That's kind of reflective also when you look at steel prices. They've been really low, iron ore and hot rolled coil, but that's been lower. Aluminum has been holding its own. That's mainly due to alumina, higher prices and shortage. I think Rusal announced cutback of aluminum today due to alumina prices. But, still continued weak demand in China is lingering. You get a couple positive numbers here and there, but nothing really exciting. So hopefully it can hold this $4 range because the forward curve outlook is more positive for sure on copper.
So, Daryl, what I hear so much about is that this electrification build out, copper is needed, and that is going to spike demand for copper, and that's why you need to be in copper. I've even heard people say copper could get up to $10, $20 a pound. What is your takeaway from these sort of comments when people are looking at big macro trends, trying to correlate it to what something like copper, a large market like copper, how it could impact price?
Yeah, I mean, fundamentally it is. It's just going to take time. It should be supportive because it's not like you can bring new mines on very quickly. I think you and I know that, and all the things that can go wrong. So forward market's showing you that it's supportive out there. So, but when you get volatility, you can get big swings. It seems like it's kind of mean reverted here to this lower $4 range and settled in. The swings you see, no different than natural gas. You can have a lot of this talk and get a lot of positioning going. And then when some of the fundamentals change, you can have these really big swings.
One thing I want to ask you about is more the longer term outlook for copper post COVID, because copper was, in a way, look, it was in a price that was mostly sub $4 for a number of years. I'm pulling up a long term chart right now that really copper got above $4 a couple of times back in 2011 and back in 2008. But broadly, again, copper and $4 was just not a level we saw. It almost seems like post COVID, we've seen a revaluation of copper mostly above that $4 level. Is this a thing we should take note of, or is this maybe just an anomaly over the last few years?
No, I'd agree. I mean, yeah, even the 5-year average is below $4. It's about 380. So I think it's just this repricing based on this infrastructure build out and the need for copper for infrastructure and EV. And it's hung in there, and the forward curve is even more supportive of that. So yeah, I tend to agree. It's kind of more of a repricing here. Let's call it like post, 22 on. We've pretty much been around this $4 range, give or take. $1.50.
Okay, that was interesting. You pointed to the 5-year average. I think that's maybe something that people should do more of is look at the average price and see what direction that is in. What sort of time frames, when you look at the average price of these metals, do you focus on to give you maybe a more reasonable handle, taking out some of the short-term spikes in terms of the direction that certain commodity prices are going?
That's a really good question. I just had this discussion with my analyst today. I said, historically, I like to look at 5-year averages, but the one thing you capture, so if you go back, like, let's go all the way back to like 2018, and your average is 360, even 20 cents lower. But with the COVID impacts from 2020, really, especially in energy, you have to be very careful about keeping those averages in. When I look at energy now, I tend to look at 3-year averages or something very long dated. But the world's changed quite a bit post COVID, post just world trade and everything. So I tend to look at 3-year averages, especially in the energy space, to get some grounding of, where are we on historically on a percentile basis. I look at that a lot in natural gas, especially on the buy side. When you start to look at winter strips or Cal 25 or Cal 26, and we're still below average, even with this run up in natural gas that we've seen. So you just have to get objective about it. And I do like 3-year averages more so on the energy side when I'm trying to get some perspective around where the price is.
Okay, interesting. Thanks, Darrell. Let's also touch on the precious metals. We don't usually touch on the precious metals. Silver is a generally small market. Gold's a bit bigger of a market, but again, not as big as some of these other commodity markets we've just touched on. We're seeing a bit of weakness, especially today as we're recording this again on Monday in the precious metals, but historically they're still at quite high prices, especially gold. Gold's not far away from all-time highs and has been screaming higher most of this year. What are you seeing in terms of precious metals from, again, a commodities trading desk?
Yeah, gold especially is more macro. You're seeing like almost a complete mirror today on gold and crude oil on this move because there's really no other big news out. Stocks are higher today, but in a vacuum today, you've got some geopolitical risk coming off, and they're both off almost exactly 3% in the front, which is interesting. Gold's, been 30% most of the year until today, and silver's been exactly 30% too up until today. So they've clearly been more macro plays, whether it's against U.S. dollar geopolitics. That's basically what you're seeing. But when fundamentals aren't in play, you're seeing something like you do today, where crude and gold are mimicking each other on the movement.
So, is this a concerning move for precious metals, taking into context? Again, it's a big move for a 1 day, but overall, these prices are broadly higher than we've seen through most of history.
Yeah, they definitely are. Gold and gold, this 2,700 at least in the short term is going to be the number to watch, and it has moved up there and held, and then we had a pretty big move off in the prior week, and then it rebounded again. So 2,700 on gold is going to be the number to watch for sure, and just some of these geopolitical activities that are going on.
All right, Darrell, we'll wrap it up here. Again, Darrell Fletcher, Managing Director, Commodities at Bannockburn Capital Markets. I'll post a link to the Bannockburn website below this interview to find out more about what that firm does. Darrell, thank you very much for your time. We'll chat again next month.
All right, thanks, Corey.